Hi everyone, we're Mimicker, here to introduce all kinds of knowledge, even the stuff we didn't know about.
Yeah, and today we are tackling something that I think is going to hit really close to home for everyone listening.
Absolutely. Welcome to today's edition of I Know You Don't Know. We're looking into an economic mystery that, honestly, affects almost every single one of you right now.
Right, if you've, ever just stood in front of a convenience store refrigerator.
Staring at the milk.
Exactly, staring at the price tag on a carton of milk and just wondering why the math doesn't seem to make any sense.
Yeah, if you've done that, this analysis is for you. We are going to completely unpack the fascinating and honestly pretty perplexing architecture of Taiwan's dairy market.
It's a really complex puzzle.
It is. We've been looking through the data we collect regarding the 2013 ANZ Tech Agreement, which is the Economic Cooperation Agreement between New Zealand and Taiwan, and this highly anticipated 2025 zero tariff policy.
Right, the big policy shift.
Exactly. And the short version of this whole puzzle is basically this. A massive structural trade barrier was just completely removed, and yet your daily carton of milk remains incredibly expensive.
It's just a phenomenal contradiction of basic economic expectations. I mean, to set the stage for you, let's look at a rather shocking metric from the data.
Lay it on us.
In 2024, Taiwan actually had the second most expensive milk in the entire world.
The second most expensive, out of everywhere.
Out of everywhere. We are talking about 101 new Taiwan dollars, which is roughly 2.7 euros per liter.
Wow.
And to give you the necessary perspective on that, in New Zealand, that exact same liter of milk costs just 64 NT dollars.
That's a huge gap. So the core mission today is to uncover the underlying mechanics keeping those prices sky high for you, even when the traditional economic rulebook dictates they should be plummeting.
Right, so let's start by analyzing this so-called zero tariff illusion because the historical context here is crucial. We really have to rewind to 2013 when Taiwan signed ANZ Tech.
Which was a monumental policy shift, right? Yeah. Because it was Taiwan's very first comprehensive trade agreement with a non-diplomatic ally.
Exactly. But policymakers knew they couldn't just open the floodgates overnight.
Right, because if they did, local Taiwanese dairy farmers would just be instantly decimated by a tsunami of imported dairy.
Yes. So to protect them, the government engineered this 12-year phase-out of tariffs on New Zealand liquid milk. It was meant to be a structured, slow-release valve.
Sort of a grace period.
Exactly. It began with a 5,500-ton quota that could enter tariff-free. Anything over that specific volume was hit with a really substantial tax of 14 NT dollars per kilogram.
Got it. And then, according to the agreement, every 3 years, that tax-free quota expanded by 1,500 tons.
Right, so that structure was explicitly designed as a long, slow runway. The intention was to give the domestic agricultural sector over a decade to upgrade, consolidate, and basically prepare for open market competition.
And now we fast forward to January 4th, 2025. We finally reached the end of that runway.
The quota system is completely abolished.
Gone. We enter an era of absolute zero tariffs on all New Zealand liquid milk entering Taiwan.
And standard economic theory and, frankly, the general expectation of the Taiwanese consumer anticipated a massive price correction.
Right. The assumption was that cheap imported milk would just immediately flood the market and drive down prices across the board.
But the reality on the ground is entirely different. You walk into a retail space today, well past that January 1st threshold, you look at the refrigerated section.
And domestic Taiwanese milk is sitting there at around 90 to 100 NT dollars per liter.
Yep. And right next to it is the New Zealand imported milk, which is now clearing customs completely tax-free, yet its price tag sits anywhere from 89 to 129 NT dollars per liter.
Which means in several cases, the imported milk is actually more expensive than the locally sourced product.
It makes no sense on the surface.
So the fundamental question we have to answer for you today is, if the state is no longer collecting that import tax, where's all that money going?
That is the pivotal question. And according to the market research we've been looking at, the answer isn't just one single variable. It's a confluence of 3 hidden price drivers.
Okay, let's break those down. What's the first one?
Driver number 1 is the reality of the global supply chain. There was this pervasive assumption that New Zealand operates as this infinite, unshakable fountain of cheap dairy just waiting to be exported.
Right, just fields of cows producing endless cheap milk.
Exactly, but that is simply no longer the case. New Zealand's agricultural sector has faced really intense headwinds recently. Their pastures have been severely impacted by climate extremes, changing weather patterns, and outbreaks of livestock diseases.
You mean the actual volume of production has contracted?
Precisely. So the fundamental raw material is becoming significantly more expensive before it even reaches a processing facility, let alone a cargo ship.
Wow.
Yeah, by early 2025, the base purchase price for raw milk in New Zealand had actually spiked by over 20% compared to the previous year.
Over 20%. That's massive. And then you have to layer on the immense logistical costs of cold chain shipping.
Right. We aren't talking about shipping dry electronics here.
No, we are talking about transporting highly perishable liquid milk thousands of miles across the Pacific Ocean. That requires specialized refrigerated containers, constant temperature monitoring, rapid port-to-shelf turnaround.
And every logistical delay or energy price fluctuation just compounds that cost. Furthermore, you have to factor in currency exchange rates, specifically the recent appreciation of the New Zealand dollar against the US dollar.
So when you aggregate that 20% raw material spike, the cold chain logistics and the currency valuation, the actual base cost to import the milk escalated dramatically.
Exactly. That base increase essentially neutralized the financial savings that were supposed to materialize from the eliminated tariff.
So the government tax vanished, but the operational baseline cost rose to fill that exact vacuum.
Yep.
Okay, that provides a really clear logistical explanation. But surely, even with a 20% spike at the source, removing a massive tariff should still leave some margin of savings for the consumer, right? Why aren't we seeing even a fractional drop at the register?
And that brings us to driver number 2, which is the fascinating psychological component of pricing strategy.
Right, we found a highly revealing quote from industry analysts regarding how these dairy importers operate. It simply asks, and I love this, if 100 works, why sell for 80?
It's a brutal but highly accurate reflection of corporate market mechanics. Industry experts have run the numbers, and based on current import costs, even with the supply chain spikes we just discussed, these companies could comfortably sell the imported milk for 80 NT dollars a liter and still maintain a healthy profit margin.
But they actively choose not to.
They deliberately position the price over 100 NT dollars, and the rationale is entirely based on maintaining a premium imported brand image.
Right, because these corporations have spent over a decade marketing New Zealand milk not as a cheap commodity, but as a pristine, high-end product from pure environments.
Exactly. If they suddenly slash the retail price to 80, they risk degrading that carefully constructed brand equity. Consumers might subconsciously perceive the newly discounted milk as lower quality.
But let me challenge that strategy for a moment. Isn't that an incredible risk in a free market? I mean, if a company is pricing their product at 100 NT, but they have the operational room to drop it to 80 NT, what stops a savvy competitor from importing their own milk, pricing it at 85 NT, and instantly capturing the entire market share?
Why doesn't someone undercut the premium illusion?
Exactly.
Well, that is exactly what you would expect in a perfectly fragmented, highly competitive market. But the Taiwanese dairy market is highly concentrated. It functions much more like an oligopoly.
Okay.
You have a few massive corporate players that control the vast majority of the processing, distribution, and even the retail shelf space. In this kind of concentrated environment, you see a phenomenon known as price leadership.
Meaning the biggest player sets the tone.
Right. The biggest player in the room sets the premium price, and rather than engaging in a race to the bottom that destroys profit margins for everyone, the smaller competitors simply shadow that pricing structure.
It's a silent understanding.
Exactly. Why start a price war when you can all comfortably ride the premium wave that the market leader established?
That makes a lot of sense, and it perfectly transitions us to driver number 3, which might be the most substantial bottleneck in this entire equation. We need to talk about the domestic retail environment and shelf fees.
Oh, the shelf fees are wild.
According to detailed reports from the Consumers Foundation and the Dairy Association, retail channels in Taiwan, meaning the ubiquitous convenience stores and the major supermarket chains, are commanding a staggering 40% margin on fresh milk.
40%. That figure is the critical structural barrier. It means that nearly half of the retail price you pay has absolutely nothing to do with the farmer, the pasteurization process, the international cold chain shipping, or the brand marketing.
It is essentially a toll booth fee simply for access to a refrigerated shelf.
Precisely. And to give you the necessary international context on that, if you look at European markets like Germany or France, Retailer margins on basic agricultural goods are fiercely competitive and usually capped well under 20%.
So why is Taiwan's retail sector able to extract double the European margin?
It comes down to the unique density of Taiwan's retail landscape. Taiwan has one of the highest densities of convenience stores globally.
Right, there's one on almost every corner.
And for a fast-moving consumer good like liquid milk, which has a very short expiration window, ultimate convenience is everything.
So if a dairy brand wants national reach and high turnover, they absolutely must be in those specific convenience store chains and the dominant supermarket networks.
Exactly. The retailers hold all the leverage. They dictate the slotting fees, the promotional discount structures, and the final shelf price. This highly top-heavy retail architecture creates a massive, rigid barrier to lower prices.
And we actually have a perfect real-world control case to prove that this retail structure is the true culprit rather than the intrinsic value of the milk itself.
The Costco exception.
The Costco exception. Costco operates on an entirely different business model. It's a membership-based, low-margin, high-volume channel.
Right.
Recently, they ran a standard promotion selling a 2-pack of 1.5-liter New Zealand milk for 159 MT dollars.
Okay, let's break down the math on that.
Yeah, if you do the math on that specific transaction, you have 3 liters total for 159 NT. That comes out to roughly 53 NT dollars per liter.
Which is incredibly revealing, because that 53 NT dollars is almost exactly the raw import cost of the milk the moment it clears customs at the port.
Exactly. It provides undeniable proof that when you bypass the traditional high-margin domestic retail channels, the price instantly collapses by nearly half.
The milk itself isn't intrinsically too expensive. The structural middleman markups are artificially inflating the cost for the average consumer.
But, you know, when the general public observes these stubbornly sky-high prices persisting despite a highly publicized zero tariff policy, human nature doesn't immediately blame cold chain logistics or slotting fees.
No, of course not. Human nature immediately suspects foul play.
Which brings us to segment 3, the ghost of cartels, past and present. This was a significant market event in late 2025 where we saw widespread public outrage.
The consumer frustration was palpable. People felt they were being actively deceived.
And this led to a massive grassroots campaign. It was a one-letter-per-person campaign that absolutely flooded Taiwan's Fair Trade Commission, the FTC, with formal complaints.
The prevailing public narrative was that the major dairy corporations were operating an illegal cartel, basically secretly colluding to fix prices and artificially gouge the consumer.
Which is an entirely rational suspicion when prices across ostensibly competing brands seem stubbornly and uniformly identical.
Right. So the pressure forced the FTC to act, and they launched a comprehensive, full-scale investigation into the major corporate importers of New Zealand milk.
They targeted industry heavyweights like Unipresident, which imports the Nushu brand, Sunledge, which handles Hangmo, and Taiwan Dairy Farm, the company behind the New Rand brand.
And in November of 2025, the FTC released their official verdict.
And what was the result?
They found absolutely zero evidence of an illegal cartel. They concluded there was no collusion, no secret backroom meetings, and no illegal price-fixing conspiracy.
I'm sure consumers were thrilled to hear that.
Oh, I'm sure. But the FTC's reasoning was meticulous and based on 4 very clear pillars of evidence.
Let's walk through those.
First, they looked at the actual market share. Despite the hype, New Zealand imported liquid milk constitutes less than 1% of the total Taiwanese dairy market.
Less than 1%.
Right. Economically speaking, it is incredibly difficult to orchestrate a successful market-wide price-fixing scheme when the product in question controls less than 1% of the playing field.
That makes sense. What was the second pillar?
Second, as we discussed at length, the removed tariffs are just one isolated variable in a highly complex cost structure.
Right, the supply chain issues.
Exactly, which leads to the third pillar. The FTC auditors aggressively examined the corporate invoices and confirmed that the actual baseline import and logistical costs had genuinely risen, completely offsetting the tariff savings.
So the paper trail proved the costs went up.
Yes. And finally, they simply found no paper trail of collusion, no emails, no memorandums, no evidence whatsoever of coordinated pricing among the competitors.
Now, if you were listening to this, you might be rolling your eyes and thinking, of course they didn't find a paper trail. These massive corporations just know how to hide it.
That's a very fair reaction.
And to be fair, Taiwanese consumers have a very legitimate historical reason to be incredibly paranoid about this exact scenario. We have to look at a crucial precedent from 2011.
The 2011 flashback.
Back then, three major domestic dairy players, Weichuan, Unipresident, and Quanchuan, actually were caught operating an illegal cartel.
Yeah, that was a huge scandal.
It was. The government had raised the raw milk purchase prices by marginal 2 NT dollars to support farmers. But in response, these three major companies simultaneously jacked up their retail prices by a massive, identical, and disproportionate margin.
And the FTC caught them dead to rights and hit them with a record-breaking 30 million NT dollar fine.
So the public's ingrained distrust is entirely justified. They've seen this movie before.
The skepticism is absolutely warranted based on that history. But the reality of the 2025 market is far more nuanced.
Because of the oligopoly structure we talked about earlier.
Exactly. As we touched on regarding price leadership, corporations simply don't need to engage in illegal backroom meetings anymore.
They don't have to risk the $30 million fine.
No. In an oligopoly, the largest player in this case, Unipresident, which boasts the largest domestic milk collection volume and controls its own massive network of convenience stores, essentially dictates the economic weather.
So if that giant sets their premium price point at 100 NT dollars, the smaller players just quietly monitor that signal and align their pricing accordingly.
Right. They achieve high, uniform prices across the entire sector without ever exchanging a single email or technically violating antitrust laws. So the takeaway here is that monopolies or oligopolies don't need backroom deals. The biggest player's price tag essentially becomes the industry's law.
That is fascinating. Now let's pivot the lens from the retail shelves and corporate strategies to the actual agricultural pastures. Segment 4, the fallout and the future.
This is where it gets really tough for the locals.
Yeah. We've established that the retail margins and global logistical costs are absorbing all the supposed savings from the zero tariff policy. But looking at the agricultural reports, the local Taiwanese dairy farmers are still facing a severe crisis.
That's true.
If the imported milk isn't actually undercutting them on price and holds such a tiny market share, what is causing the immense financial pressure at the production level?
It's a deeply frustrating paradox for the local producers. Even though the imported milk hasn't physically taken over the market volume, the psychological fear of it, compounded by shifting consumer habits, has caused a very real contraction.
How bad is it?
Some local farmers have reported up to a 20% drop in overall sales volume.
A 20% drop. That's devastating. And the research highlights a profoundly structural issue regarding how processors interact with farmers during periods of uncertainty.
The culling incident.
Yes, the culling incident. In mid-2024, the major domestic dairy factories were terrified about the impending 2025 zero tariff policy. They panicked.
They really did.
Anticipating a flood of cheap imports, they went to their contracted local farmers and essentially mandated a production cut. They forced these farmers to prematurely cull their herds to artificially reduce domestic milk production by 10%.
It was a drastic defensive supply chain maneuver by the processing factories, but it reveals a fundamental flaw in how corporate entities view agricultural supply.
Because you can't just turn cows on and off like a machine.
Exactly. By February 2025, once the factories realized that the imported milk was saddled with high logistical costs and wasn't going to crash the retail market, they reversed course.
They lifted the production limits and asked for the milk back.
But that is where the reality of biology clashes with corporate spreadsheets. Dairy herds have a rigid biological lead time.
Right, a farmer cannot simply reboot a culled herd to peak milk production in a matter of weeks. The process of breeding, raising, and integrating new dairy cows takes well over a year.
The farmers took the severe financial hit of culling their herds, lost their underlying capital assets, and were left entirely stranded when the market winds shifted and the factories changed their minds.
It brilliantly illustrates the immense power imbalance in the agricultural supply chain.
It really does. But what is highly encouraging is observing how the broader market ecosystem is actively adapting to bypass this dysfunction.
The producers aren't just passively accepting these terms.
No, recognizing that the retail middlemen are extracting all the potential profit, a growing number of farmers are actively circumventing the traditional supermarket networks.
We are seeing a surge in direct-to-consumer delivery models. Farmers are opening specialized independent milk shops.
Furthermore, many are pivoting their excess raw milk into higher-margin, longer shelf-life products like artisanal cheeses and yogurts.
Right, successfully diversifying their revenue streams away from the volatile liquid milk market.
And the Taiwanese consumers are fundamentally altering their behavior as well. You are seeing the game being played on the supermarket shelves, and you are exploring alternative avenues.
The data shows a significant shift in daily habits. A measurable percentage of the public is migrating toward alternatives like soy milk or returning to highly stable powdered milk options.
More fascinatingly, we are seeing the rise of the group buy economy. Entire communities and neighborhood networks are pooling their purchasing power to buy directly from the local farms in bulk.
It is essentially a grassroots economic rebellion designed to completely bypass that 40% retail markup.
It's incredible to see. And finally, the government is attempting to architect a more sustainable landscape.
The Ministry of Agriculture is actively drafting a comprehensive white paper on dairy to map out long-term survival strategies for the sector.
They are heavily promoting animal welfare certifications to add tangible value to domestic products. But strategically, their primary goal is to establish a unified national premium brand identity for local fresh milk.
They want to draw a stark, unmissable line for the consumer, separating the ultra-fresh, locally sourced Taiwanese milk from the imported milk that has spent weeks traversing the ocean in a cargo ship.
The objective is to justify a premium price point where the margin actually returns to the local farmer rather than being captured by the retail logistics network.
This has been a remarkably dense exploration, so let's synthesize the core insights for you. The overarching lesson of this deep dive is the reality of the zero-tariff illusion.
The natural assumption is that eliminating a government tax mathematically guarantees lower consumer prices.
But our analysis proves that removing a tariff does absolutely nothing to fix a rigid, top-heavy market structure.
When you have a domestic retail environment demanding a 40% toll fee, combined with corporate oligopolies focused on maintaining premium brand illusions rather than competing on volume, the price at the register remains completely static.
The capital simply reroutes. It shifts from the government's public tax revenue directly into the private ledgers of international logistics firms and domestic retail conglomerates.
That perfectly encapsulates the current dynamic, but I want to leave you with a final, somewhat provocative thought extrapolated from the trends we've discussed today.
Let's hear it.
Currently, New Zealand milk constitutes less than 1% of the Taiwanese market. The domestic agricultural structure barely weathered this specific transition, and they were largely saved because global supply chain issues made New Zealand milk unexpectedly expensive to import.
Right, they got lucky with the timing.
But consider the horizon. What happens when massive, geopolitically powerful dairy exporters like the United States or Australia arrive at the negotiating table and demand the exact same zero-tariff access that New Zealand received?
Oh, wow.
If Taiwan's internal market structure is exorbitant shelf fees, the fragile biological lead times for farmers, and the lack of retail competition doesn't undergo fundamental structural reform immediately, will the entire local dairy industry simply collapse under the weight of the next exponentially larger wave of global imports?
That is a chilling thought to end on, but definitely something to keep an eye on in the coming years. Thanks for tuning into this episode. If you enjoyed our content, don't forget to like, subscribe, share, and turn on the notification bell. See you guys.